Hey everybody, it's Chris Buteau with Cleveland Street Mortgage, and I want to talk to you today about the differences between a conventional loan and an FHA loan, particularly with an emphasis on first-time home buyers with low down payment. Because there are significant differences, and generally conventional is going to be significantly better if you can qualify for that. And so it's especially important if you just have kind of gotten into the mode of thinking you need an FHA, or you're working with someone and that's where they're taking you. That may be just the right decision, but it's important you understand the differences and make sure that you have considered the conventional alternatives. So let's just talk about the differences primarily. First of all, conventional loans, to get a 3% down, which what I'm talking about, low down conventional loan, to get a 3% down, you do have to be a first-time home buyer, which means you haven't purchased in the last 3 years, owned a home in the last 3 years. FHA doesn't require that. So if you're not a first-time home buyer, you may need to go FHA. First difference is, the conventional loan is 3% down, FHA is 0.5%. So when you're scrambling for that money, and my examples here are going to use a $500,000 purchase price, which is not a lot of house in the area I am in, the Seattle area, but let's just use that. That's a 0.5% difference, or $2,500 more cash. So if you're scrambling for cash, conventional is going to be better. So cash to close will be less with a conventional. Credit scores will be lower for FHA as well. So this might be a reason you'll be taken there if your credit score isn't great. The minimum credit score for conventional loan, first-time home buyer, isn't super high. It's like 620 typically. But if you're below that, you might need to go FHA. But when I take a $500,000 purchase and I do an FHA at 3.5 or conventional at 3% down, your monthly payment is going to be very similar. Now it's about $45 a month better with conventional, which on a $2,500 with taxes and insurance and everything else, included, isn't a huge difference. But it's better. For conventional, it's going to be about, in my example, about $45 a month better. But here's where, one of the real kickers comes in, is mortgage insurance component of that. The monthly mortgage insurance on a conventional loan is going to be at $206 a month, whereas FHA is going to be $342. Now that's already factored into that total payment difference, but the conventional loan mortgage insurance is potentially removable. If you achieve enough equity, if you have market appreciation in your house, and you can get to that 78% threshold, you can potentially have that mortgage insurance removed, whereas FHA, it's never removable. So that $342 a month component of your FHA payment is permanent, while that $206 component of your conventional payment is potentially removable. And so, that could change that $45 a month difference into a $250 a month difference once you get that removed. The funding fee is really one of the major differences between the two. On an FHA loan, there's an upfront funding fee, a one-time of 1.75 points. So in my example, in a $500,000 purchase, that's an $8,400 difference. Now, you may not feel that or notice that. You should notice it, but you may not, because it gets rolled into the loan. So it doesn't increase your cash to close by that amount, right? It just gets rolled into the loan, but it is a real cost, and you do have to pay it back, and it diminishes your equity, right? So if you just add that fee into your loan amount, you're borrowing more, and your equity is less at closing, and you've really incurred that cost. And this, again, in this case, that's an $8,400 difference. Very significant difference there. And so your equity in these two examples, even though you're bringing more cash to close, about $2,500 on an FHA loan, your equity is $6,000 less, because you brought more cash to close, but you also rolled in a very large funding fee on top of that. So the fees are much higher with FHA, typical. And then there's a couple other, things, for example, condos. If you're looking at condos, FHA will only finance FHA approved condos. And that's typically the minority of condos on the market at any given time are going to be FHA approved. Now, it's possible to get them spot approved, but that's going to add time and expense, to your approval process and uncertainty. Whereas, conventional can do, most condos. There are some limitations, and certain condos aren't doable, but most condos are going to be doable. And then another thing is the FHA requires the seller to sign what's called an amendatory clause. Now, in general, that's a good thing for the buyer, because it basically says the seller cannot hold you to the contract if the appraisal comes in low. And in a competitive market like we have here, a lot of times buyers will offer to waive that appraisal contingency because they want to get the deal. And FHA says you cannot waive that. You can buy it if it comes in low. You can agree to do it after the fact and say, yeah, I'll still want to buy it, but they can't force you to do that. That's called the amendatory clause, which is great for the buyer. However, in a competitive market, that's going to make your offer less attractive to a seller because they can't accept that kind of a thing. So anyway, a few differences there. Hope that helps. Thanks so much.